In this video, we're going to address how we can use LEAPS to increase the rate of return on our investment accounts, speeding up that time frame of when we can get to retirement and really catapult us into the next level. So stick around. I'm hoping it's a great video. Hello, my YouTube friends. My name is Adam Kahn. This is Investing with Adam K. Forgive that the hair is always a mess. I haven't been preparing for the videos a whole lot. I've been working from my backyard, which is really nice. I wear these cheap, lousy shirts just because I'm hanging out, having a nice time. I'm sure that's what you guys focus on. Since I see myself in the camera, it's what I focus on. Anyway, I hope everybody's doing well. I hope your week was great. I hope your portfolios are doing incredible considering the markets are near their highs. I do think maybe tomorrow, or I hope for potentially a little bit of a pullback so that we don't just shoot straight up too quickly and start hitting further into that bubble type of zone. I'm still bullish the economy. I think things are doing better than they say. And the fact that so much negative news keeps being pounded at it and the market keeps going higher seems to be like that's the direction we're going. And as they say, the trend is your friend. So I really want to delve into LEAPS and that retirement dream of everybody and living off a passive income, potentially, as a lot of people talk about, that FIRE lifestyle. But what's the advantage of LEAPS and what is everybody talking about it? Because I'm seeing tons of videos on YouTube. And the reason I want to talk about it is I want to debunk some of the things they're getting into and warn people about the risks associated with it. Because in a lot of videos, they really don't get into that. And those of you who've been watching for a little while, I'm pretty conservative and I hope for the best for everybody. And I don't want to see people jumping into things because it sounds so great on somebody's video. And maybe it's not as great as it sounds. And some of the things they leave out is it's a way to be leveraged and you're taking on more risks than you realize. It's not as simple as if you just buy a stock and it goes higher, that I'm going to crush it. Now, that is the case. Since you are leveraged, if you buy a stock that's going higher and you have leaps instead of the underlying, and you buy more of it because that's what it allows you to do, you'll probably outperform versus just buying the stock. But in the last video I watched, essentially he said, the main thing to do is pick stocks that are going higher. Well, duh. Isn't that the goal of everybody and what we try to do when we pick our stocks? So if you knew what stocks were going higher, well, geez, why wouldn't you just leverage as much as possible because they're just going to go higher? Yes, you want to pick stocks that are going higher. If people were that incredibly good at it that they always knew which ones they were picking that would go higher, they wouldn't have to worry about any of this or start doing any of the analysis that they're doing. So why are leaps attractive? So I talked about Palantir a bit, and I'm going to hit pause in a second so it can actually go research and give you real numbers on it. But I'll show you the example of the advantage of Palantir, because even when I talked about it the other day, I realized some of my math was actually wrong, and the leaps are even more attractive in some ways than what I was saying. Again, I don't think it's a good strategy, and I'm going to talk about the risks associated, not just what you can make on it, but why the problem lies in it of what might happen if it doesn't go higher. So stick around. Now, here's what I would look for in a leap and how I try to kind of structure the price that I'd be paying, the strike price of the leap, the date that I'm looking at in a company like Palantir. If I want to be getting long Palantir, but I'm a little bit too nervous of how much it bounces around, how volatile it is, when I look at a leap, I kind of look at it closed on Friday at 159 and change. So let's call it 160 just to make math easy and kind of round it off. What I would do is divide that 160 by 2, call it $80, go out to the furthest option possible, which is December of 2027. Well, we're still only in 2025. We're in the middle of August. That gives us well over 2 years that option's in play. The reason I divided it by 2 is I would look for the call that costs about $80 per option and see what that strike price is. In Palantir's case, that's around $110 for the call, which was trading between $78 and change and $79 and change. So if you had to buy the offer, it looked like what it closed at on Friday was $79.55. So if you bought one of those calls, you're paying $7,900, $79.55 essentially. Two of them is the same price as buying 100 shares of the stock. So, essentially 79 times 2 or 80 times 2. So the math is easy and you're back at the 160. If you're long two of those leaps, if the stock goes higher, you end up being long 200 shares instead of 100. Let's talk about the advantages first. If the stock goes higher, first of all, you're buying the $110 call. So you already have $50 of cushion inside of it. And you're paying $80, which means you have about $30 that you need to go it up before you're at break even. So 160 plus 30, $190 a share is your break even price. Two and a almost a half, so 2 1/3 years to get there. And a stock as volatile as Palantir doesn't seem so outrageous. Now, part of that is the volatility means it can go either direction, so it also accounts for it could go lower. Let's still talk about if it goes higher. Now, if Palantir gets to $300 a share, and you have 200 shares essentially from $110 a share, you've really hit it out of the ballpark. So when you break down the math and work it out, you could make $22,000 on the same investment amount versus making $14,000 if you bought the stock outright by using the leaps. And percentage wise, you're really crushing it if you look at that. 22,000 versus 14,000, but you're making 50% more or so. You're really hitting it out of the ballpark. Now, the thing is you have some downside risk there. And let me do the math real quick so everybody understands it since I just jumped into it. So you bought two of the calls, you paid $110 a piece. You spent $16,000 on that. At $300 a share, if you're selling those stock outright, because that's where it traded on day of expiration, it gets assigned to you, and the math is exactly perfect. You're collecting 60,000 less the 16 that you paid for the options. So you go from 60 to 50 to 44, right? Everybody, hopefully I do this right. Less you had to pay 110 for each option, so you're paying 11,000 a piece. So 22,000 minus from the 44,000, you're at a $22,000 profit, right? Somewhere I think I messed up a bit, but I think that's about right. Versus if you bought 100 shares at $160 a share, it goes up to $300 a share. 30,000 minus the 16,000, you have a $14,000 profit. So you see how it works out. You see how you're long 200 shares versus one in one respect. You are buying it from a bit of a, you have to pay the premium to get there, which costs you about $30 per option in terms of it's at 110, it's already at 160, and it has to get to 190 to break even. Sorry, my brain just kind of goes sometimes. Either way, you see the advantage. You understand, wow, I could really do well. I don't have to put up any more money, and I get much better returns if the stock does well. Now, there's also kind of break even levels in there where you're making more in the stock and it slowly dwindles to where you're making the same to where you're doing better in the leap. And the leap has to do really well for you to do much better on it. The other thing is you do have time value. So if the stock goes up in a short amount of time from where you buy the leaps, you could have an opportunity to get out of them and still get all the option value and have a nice profit, which would have outperformed what the stock did as well. But this is also trading and not investing. We'll talk about that a little later as well. And to be fair, I really don't recommend this, which is why I wanted to get in the video because I've seen so many of them and I know I'm talking about the good first, but I don't want people to focus on that because I know most of you don't watch the video all the way through and you'll hear that part of it and think, damn, this is really good. This guy's talking about it even though he says it's not a great thing. Here's the first negative. Let's say the stock does fine, but doesn't go anywhere. Like in 2.5 years, come December, it's still around the same $160 a share. Well, what ends up happening? You would have broken even on the stock because it hasn't gone anywhere, but you would have lost the premium that you paid for the option. So you would have lost essentially $30 a share. You'd get the $50 of what you have in terms of the cushion that you're buying the 110 call, it's still at 160, and you get most of your money back. Not the end of the world, but not so great, considering if you just bought the stock, you broke even and you didn't lose anything. In this scenario, you've lost $6,000 on your $16,000 investment. You still have $10,000, but that's a pretty good clip for not being wrong or right and the stock just sitting around. And then the negative scenario. Let's say the stock drops to $100 a share. If you buy the stock, you're down $6,000, which sucks as well. I don't want to, detract from that and talk about it like it's that great. But in the scenario of the leaps, you've lost all of your money, which is why I say it's using leverage to be long something. It's not as simple as I'm just buying it and oh, what a better way. This is like free money because the market always goes up. I think a lot of people talking about these leaps are younger and haven't seen long term markets that have been slow or stagnant or even gone down. And that does happen. I understand we're in a bullish market. I understand it's been going up. I understand that they saw a couple of really big pullbacks in the market and the market just keeps rocketing higher. But I think that's blinding them from the potential of what could happen. And the funny thing is, I don't think we're there yet. I do think it's coming, but I think it could be a ways out still. I mean, we might have another 5 years of just the market running. Man, oh man, I'm not hitting pause because I lose track. I'm hitting pause because in the morning the little mosquitoes come out and my nose is itching and my legs and I got a scratch and I don't want to sit there scratching on the video. Anyway, so the negative is you're really leveraged. I don't think a lot of these people have seen a market that's stagnant or declining. I think they're a little blinded by it's just a great market. And the thing is, like I said, it really could go another 5 years. When I think of the internet bubble and what was going on, and people talk about, you know, your waiter, your waitress, the person at the bookstore, like everybody was talking about the stocks. Why? Because it had gone up long enough that they had watched other people get wealthy that they finally started jumping in. I don't think we're at that point yet. While assets have gone up, it's just been kind of more the haves and have nots. When it gets to the point that the market just goes up how it has been for another 3, 4, or potentially even 5 years, and people are really talking about how they're getting rich with stocks, they're doing incredible, and you can't lose, and you start hearing it from the Starbucks clerk when you go get your coffee or whatever it is you do, and it just starts being conversation with people you never thought you'd hear it from. That's when it's really gone way too far, and it's time to get out, sit on the sidelines, and just wait and watch until things fall out. I don't see us there yet. I think there's a lot of YouTubers and people who like finance talking about it, but if I went into the office and I do mortgages, I'm in the finance world, and started talking about the stock market, most of the employees would just look at me like I'm nuts and say, "Yeah, I think I'm in the 401k plan or whatever it is that we offer at our office." I don't think they'd be talking about it the way it was in the internet bubble. You can also go back to when Bitcoin went to 60,000 the first time, and same thing. Everybody was talking about their Shiba Inu and their Dogecoin and whatever else that people were getting rich on before it crashed and fell out. And while those things and Bitcoin are making new high and beginning to get back in the scene, I don't think it's drawn people in yet. I distinctly remember being at a Super Bowl party with at a buddy of mine's house, where everybody at the party was talking about their Shiba Inu investment and their other ones and how they were getting in crypto, and it was all sorts of people who never had, that you never would have thought would, who it made no sense that they're getting invested in this stuff, and that's when it all crashed. And I hate to say that's pretty typical. It's when it sucks everybody in from all sorts of the angles that wouldn't typically be invested, that's when the markets crash. I know it seems overpriced. I know it doesn't make sense, but that is not the case right now. I think most people invested are typically invested. The stock market seems pretty normal, and the news is bad enough keeping people nervous that as long as the news is bad and the markets keep going higher, ignoring the news, the trend is your friend. I don't see that changing. And I keep waiting for that sentiment to where everybody's talking about it. I haven't seen it yet. So I am still bullish. And I also recognize the value of leaps, and I do use them to some degree. I just think it's a mistake for most people. And when I use it, I've talked about this a lot, and let me talk about it a little bit more. There's a reason I have a minimum of three accounts and the percentages of the portfolio I have in them. My set it and forget it account. And I can do a video. If you want, make comments in the comment section. I will go over the stocks again, what's in there, the percentage of the portfolio it is, and everything else. My set it and forget it account is about 90% of my investment account. What is it? It's the stocks that I think are great companies. I don't trade them. I don't sell covered calls. I don't sell puts to get into things. I just want to own those companies as an investment. I think they're good companies that I want to be a part owner of, and I think they're going to continue to grow over time. Now, I've started diversifying them. The only thing I think I might do is diversify even more because it's probably time to take risk off the table and not be in some of the growth because it's done so well. Start going into more boring, less volatile stocks, which will actually underperform the market on purpose. And those of you who look at me like I'm nuts, like, why would you want to underperform? The reality is because that's okay. I don't need to do better than the market. What I need to do is preserve capital for me, which goes into why you can't listen to people on YouTube. This is that disclaimer of you need to do your own research. I am not a financial advisor. By all means, don't listen to me or anybody else on the internet for the investment and things that you need to do. You need to talk to a financial advisor and decide what fits your portfolio and what your investment goals are for your life. And the reality is, and this is separate, this is not part of the disclaimer, when you talk to that investment advisor, their first question should be, what's the goal for the money that you're investing? And that's not this simple, well, I want it to make more money. You really have to think about what your goal is with that money. Is it to preserve it? Is it money that you have that you're able to risk, that you really want to take a gamble, and if you lose it, that's okay too. Like, you have to delineate those things. So 90% is in that account. Another 7 or 8% is in a dividend account that I'll play around with. I watch it from time to time. I might make changes. Recently, I actually rotated out of the dividends into Google and Amazon. I'm not suggesting others do that, but timing was like lucky. I feel like we've gotten stretched, even though I do think that's the long-term trend. Um, but again, I only wield a small percentage of the account because I don't want to do anything I shouldn't be doing, and I don't want to mess up on anything that could really do damage to my investments. And then I take 1 to 2, maybe 3% of the account and I trade it. And I get very aggressive. I sell calls, I sell puts, I'm long stock, I might even short stock in things. But I like to do that and I watch the markets all the time. And if that money gets lost, it's not the end of the world because it's such a small percentage of the overall portfolio. And I enjoy doing that and I enjoy doing the videos. So I don't want it heard the wrong way when I'm talking about trades and leaps, which I do use in that account, or things of that nature that I see as high risk, as these are great opportunities to get you to that next level and be able to retire early. Now, if you're 25 years old and you're a trader and that's what you decide to do, you want to do, or you're young enough and you're just more aggressive, I get it. But I'd hate to see people getting closer to retirement watching some of the videos on YouTube thinking it's easier than it is and just plowing their money into these really risky things while they leave out a lot of the negative. I mean, the main thing the guy was saying about how you just have to pick a stock that's going higher. And to be fair, at the time, he was talking about Tesla when it was trading like $430 a share and buying leaps for it. Well, that wouldn't have worked out real well. And not only that, he would have lost the time that was in the leaps because it was almost 9 months ago. So if he bought a 2 year leap, when the price was higher, and now we're at, I don't know, where's Tesla? I haven't looked at it. So $330 a share. So if it's dropped $100 from when he bought the leaps and he's lost a year's time, the value of that leap is going to drop dramatically. So it would have been a terrible investment. He didn't focus on that one. He talked about a leap that he bought in Google because Google had gone up and he had done really well. And he talked about the math of essentially he had almost doubled his money in Google. Well, that's great, but you didn't pick everything that went up. You stopped talking about the Tesla one and didn't talk about it again from what I could see. and you likely got, or he likely got crushed on it. So it is not so simple. And the ones who talk about getting 100% return year over year, it's just highly improbable that that's what everybody's going to be able to do. And it's just that simple. You're going to have ups, you're going to have downs, and using these strategies is just a way of being leveraged. So you do have the potential of turning less money into a good bit more versus just investing, but it's a lot riskier as well. You can also run into the situation where you lose that money or lose a good portion of it, even if the market has done well. I did lie like I usually do. I went and did the math. I have a little over 80% in the set it and forget it. I have about 12 to 14% in the dividend account, and then I have about 5% in the one that I trade. But I don't expect to lose 100% of the one that I trade. And unfortunately, even if I did lose 100% of it, it would still be okay. So I just say be really careful. Don't use these strategies for 100% of the investments you make. Now, I'm not a financial advisor. If you talk to yours and they suggest otherwise, I don't want to disagree with anybody, and this is not investment advice by any means. I'm just sharing what's worked for me, and what's worked for me is being conservative on most of it. I know that it's super boring. I know it takes a long time, but it also sets a habit that helps you get to the position you want to be in. If you get in the habit of saving and putting away and not getting overly aggressive to try to make it happen sooner than later, you have the right mindset when you get there about saving and being safe and everything else. It's very hard for me to just transition into spending from saving, which I think a lot of people who get to retirement run into the same thing. They've worked so many years, they've worked 60 or 70 years of trying to save and put themselves in the right position, that when they're finally in the right position, it is not so simple to just flip the switch and go from saving to spending and not continuing to put away, which is why they end up just leaving it to their kids. Now, the weird thing is, it gives me a lot of satisfaction. And I listen to this Gen X dividend investor who I forget to talk about every now and then because I really like his channel. And he talks about as you get older and how to set things up for your family and how to put it in the right position. I don't know how to explain, but I get a lot of satisfaction about the hope and dream of having enough that when I pass away that my wife and son don't need to worry about it. The thing that he talked about in this week's video, which I know he's right about, is either setting up some really specific instructions of how to transition the money from when you pass to how it should be set up for them when they receive it, because my wife could care less about investing. Like, she doesn't want to learn. I wish she did. I think women are actually probably better investors than men, the way that they're analytical and they pay attention to certain things. And I know they seem more emotional, but in these things I think they'd actually be less emotional and able to make really good decisions. I kind of wish she took an interest into it, but I don't know if it's just gender roles or the reason, but she doesn't really want to learn and kind of trusts that I take care of it, which is fine. Just put some pressure about making sure there's enough that she's comfortable and lives the way she lives. Either way, she doesn't want to learn about it. And I don't know that my son will. Like, he asks questions from time to time, but for the most part, he wants to be a lawyer. He wants to work a job. He doesn't think about the investing a whole lot. He's only 14, so maybe that'll change as he gets a little bit older. And that's all okay, but I don't want to make any presumption that he will. So I'm thinking about either setting it up where it goes into somewhere that they handle it and give out distributions. But I hate the idea of that because I always hate the idea. Or very specific instructions of the things it needs to be invested in the minute I pass so they can make a transition in the account, put it into those things so that they have dividends coming in that they can hopefully rely on to be able to pay their bills without having to learn or worry about the markets. Like, to me, there's a great satisfaction in trying to come up with that strategy and having those changes made automatically if something happened. I know it's kind of weird that you think about these things. Now, the guy Gen X dividend investing, he's been having some health issues. I think he's young enough and okay, but there's something going on that makes him think about it a whole lot more. I don't know why I do. I mean, I'm not that old yet, but you never know if you get hit by a bus. And it's weird that that's what you think about and kind of get satisfaction in thinking I could set it up like this and they'd be just fine. So, for those of you who are older in similar positions, I think it's something to think about if you haven't done it already. But getting things in order where it's set up properly so that if something does happen, you know that that money will be transitioned the way you would like it to so that it can be handle the things that you hope it can handle. Like for me, my goal is not to just spend it and enjoy it. I enjoy having the money and seeing it grow as well. Like, and there aren't a whole things I really want. Just to share, like, so my buddy's been pushing me to get myself a nice watch. Now, I have what I think is a decent watch, but he wants me to really get something over the top to treat myself and whatever else. When we went on our vacation, part of it was, okay, I'll go find a watch. Well, A, it was overwhelming. Like there's a zillion watches to choose from. So B, I couldn't really find the one I love so much. And C, even when I thought about it, when I looked at the prices, I just thought, how much satisfaction am I really going to get? Like, is there really a point? And do I care one way or another? And maybe I should worry about impressing somebody else for some stupid reason, but I don't know that it would give me the satisfaction. I'm still thinking about it because there were some that I like, and maybe I end up buying one, but I haven't really figured out if it matters. The only part that mattered to me, the one thing that I really wanted, is it would be something that my son would get that he would look at and think of his dad. Like to me, that's really cool because, when my mom passed, the things that I wanted were such small little trinkets. It wasn't about if I could get this or that. Like I wanted something that when we went on a we all went on a cruise to Alaska. She ended up getting sick on the cruise, and I, since we have a good, I got off with her because she had to go to the hospital. Now I caught up to the cruise and they flew her back home and everything was fine. But somebody wanted to make sure she was safe. But when we got off and it was a cruise in Alaska, I bought this little, I don't know if it's a jewelry box or what, like it was made out of baleen, which she knew exactly what that was. I had no idea, but it was just this tiny little thing with a little polar bear or something on the top that you close and it almost looks like wicker, but it couldn't be more than like this big. That was the thing that was important to me. So when I look at the watch, I kind of think the same thing, that that could be like the nice thing that he could wear on his wrist and remember his dad and have special memories and remember the trips and everything else. Anyway, I know that's not about investing, but it all is and it all goes together because it's what our goals in life are. So in terms of the leaps, I suggest stay away from them unless you have an amount of money you can play with, because it does give you the ability to potentially do better, but you're just taking on leverage. You're not doing any big trick. It's not something that somebody's telling you. Like, there is no secret pill. Anything that anybody's thought of is something that somebody else has, and you're competing against computer algorithms that are actually pretty good. I listened to, it wasn't Tom Lee. It was God, I don't even remember who it was, but he was talking about the analysis of, how Meta would do and the others, and their system even took into account when, I forget which holiday it was, but Easter lay, because that changes when the quarter ends and it could impact earnings like 0.01%. And if it was a leap year versus a non leap year, because it gives an extra day in a quarter as well as the year, and that changes things versus it's an election year. Like their algorithms take so many things into play that our brains just don't. And any news and any information that we have, so do they as well. So you're competing against systems that are beyond intricate and really priced pretty well, which is why I think you just save and put away and buy good companies and everything will just work out. And if you do want to play with leaps, by all means, go right ahead. Just make sure you understand what it is you're getting involved with. And don't just follow these guys on YouTube simply because it sounds great and they talk about something that they hit it out of the ballpark on. Because my guess is there's some things they didn't hit it out of the ballpark on as well. Anyway, as always, Tomorrow's Monday, my favorite day of the week. I know most people hate it, but I like when the markets are open. Do me a favor if you haven't already and hit that subscribe button. Smash that like button. Make some comments in the comment section. Have a great day. Bye-bye.